The market yesterday was honestly pretty fascinating. If you were just looking at the headline numbers, it looked almost perfect. All three major indexes pushed higher. The VIX dropped to 17, Treasury yields continued to slide, and risk assets across the board caught a bid. Even Bitcoin joined the party. But once you look deeper, you start to realize this rally wasn't driven by some huge improvement in economic data or corporate fundamentals. It was mainly a combination of improved sentiment, short covering, and a lack of sellers in the classic holiday week squeeze. What's interesting is that nothing major happened yesterday. There was no new macro data that changed the story, no big earnings reports, and yet the market pushed strongly higher. That kind of move tells you something important. This wasn't strong buying pushing the market up. It was the absence of selling. And honestly, this pattern has been the foundation of U.S. markets for more than a decade. On the way down, you usually see panic, big volume, forced selling. On the way up, it often happens on light volume, simply because sellers step aside. That's exactly what we saw yesterday. The VIX dropping to 17 is a clear sign that fear is gone for now. Investors aren't pricing in much near-term risk at all. Treasury yields continue to drift lower, which is huge for tech stocks. Whenever yields fall, growth stocks breathe easier. And when Bitcoin rallies at the same time, that usually means risk appetite is turning back on across the entire market. But again, this wasn't data-driven, it was sentiment-driven. Now let's talk about structure. SPY's action yesterday was textbook short squeeze behavior. You could see shorts getting squeezed out of positions across tech, hedge funds flipping from short to long, and systematic players reducing hedges. When those pieces combine, even with very low volume, the index gets pushed higher pretty easily. That's why the tape looks so smooth and controlled. The catch is this: short squeeze rallies can look very strong on the surface, but they aren't the kind of strength that you want to blindly chase. SPY right now is stretched. Not overextended, but definitely in a spot where upside is less comfortable. The short-term deviation is about plus 1%. Again, that doesn't mean we're at the top, but it does mean this isn't the safest place to aggressively chase. You can see it in how the market moved. Everything drifted higher, but there wasn't a powerful wave of buying behind it. It was almost like the market floated up. Now let's talk key levels. SPY has three important levels I'm watching closely. First is 670. A pullback to this level would be completely healthy. That's what strong markets do. They go up, pull back, hold support, and then move again. If SPY stays above 670, the structure is still strong. If SPY breaks 670, that would tell me the short squeeze phase is probably fading and we might enter a period of chop. Doesn't mean a crash, just means the easy part of the move is likely over. On the upside, 690 is the spot where the next test happens, but the only way we get there is if shorts continue to capitulate. If more shorts throw in the towel, SPY could definitely pop into that range. If not, we'll likely chop between 680 and 690 for a bit. Now let's shift to tech and the AI names, because this is where a lot of people are getting confused. Tech has been bouncing, yes. AI names have been bouncing, yes. But these moves have much more to do with technical oversold conditions and short covering than anything fundamentally improving. Look at Oracle. Its recent bounce didn't come from strong new fundamentals. It came from the stock being deeply oversold. The story with OpenAI dependency, data center costs, and margin pressure hasn't suddenly gone away. SoftBank, it had a massive drop earlier, and the bounce now is simply a rebound from extreme levels. The underlying concerns are still there. Dell is selling a ton of AI servers. That part is real, but the pressure on margins is real too. High volume doesn't always mean high profit. HPQ revenue was fine, but profitability and future guidance were not. They're dealing with cost pressures and leaning on layoffs. A technical bounce doesn't fix those issues. Scholar is another example. Their earnings were actually pretty solid. But in this market, solid sometimes isn't enough. Wall Street wants much better than expected, not just good. The theme here is simple. Tech isn't weak. Expectations are just incredibly high. The market is no longer in that 2023-2024 phase where AI stock rush or guaranteed rally. We're in the phase where investors want to see real earnings growth, not just excitement. Now let's talk about the next few days, because this is where timing really matters. Today is Thanksgiving. The market is closed. That alone changes everything. Holiday weeks always have extremely low liquidity. And when liquidity drops this low, the market tends to look unusually stable because big institutional players don't make major moves during these days. But individual stocks, they can get very jumpy. Tomorrow, Friday, is only a half day. Historically, volume is around 70% or even less compared to a normal session. In this environment, you should expect unusual, sometimes random-looking moves, especially in mid-caps and small caps. Don't let those moves trick you. Then comes Monday, the first full trading day after the holiday, and historically, the Monday after Thanksgiving is a little shaky. The S&P has averaged around a 0.4% dip on that day. Why? Because that's when liquidity fully returns. That's when institutional players reassess their positions, and that's when the market often tests whether this short squeeze rally has real legs or whether it needs to unwind a little. So right now, the name of the game is timing and pacing. This is not the moment to be overly aggressive. It's not the time to chase every green candle. Strong markets are great, but you still need to let them prove themselves once real volume comes back next week. Your job right now is to watch structure. Watch how the market behaves once liquidity returns. Watch whether shorts keep capitulating or whether they start reloading. Watch if SPY pulls back to a more comfortable entry area or if it just grinds sideways and rebuilds energy. Bulls have control right now, no doubt, but it's a very specific kind of control. It's short covering control, not long-term trend control. Those are very different things. So let me wrap this up. The rally we saw yesterday was driven more by sentiment and lack of selling pressure than by strong fundamentals. Low-volume rallies are extremely common in the U.S. market, and they are not bearish by default. But they do require more patience and more discipline. SPY looks strong, but not in a way where you want to aggressively chase. Tech and AI names are stabilizing, but in a market where expectations are sky high, you need to be selective. And with today being Thanksgiving and tomorrow being a half day, this is a period to observe rather than force trades. The real signal comes next week. If you found today's breakdown helpful, make sure you subscribe. I'll keep giving you straightforward, no BS explanations of what's actually happening in the market. And if there's any stock you want me to cover next, just let me know in the comments. I always check. I'm Steve. Thanks for watching, and I'll see you in the next one. And if there's any stock you want me to cover next, just let me know in the comments. I always check. I'm Steve. Thanks for watching, and I'll see you in the next one.